My question that I want to answer and I want to ask you is, can Walt Disney really hit $100 billion in revenue by 2024? Welcome to the Valuation Masterclass case study, where you're going to learn about interesting stocks and how to value them. What's interesting about Walt Disney is that its streaming platform reached 120 million users in less than 2 years. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. So, can Walt Disney really hit this $100 billion revenue by 2024? Well, first of all, let's look at the company. The Walt Disney Company is in the communication services sector in the US. It's among the largest family entertainment and media enterprises in the world. It started with animation films, but expanded subsequently to film production, television, and theme parks. There's 3 things that you need to know about this company. Over the past 9 years, Disney saw a 5% cumulative average growth rate of revenue. The streaming platform, Disney Plus, comprises a new growth engine, which we're going to look at. And the fast recovery of theme parks could drive the revenue rebound. Let's look at some key statistics. First of all, there's 34 analysts covering the company, and they have a strong buy with a 45% upside. That's a $191 price target. The PE is 38 times, which is relatively expensive, and no dividend yield right now. So, how Walt Disney actually makes money? Let's look into that. First, it's media and entertainment, which accounts for 75% of its revenue. This can be broken down into affiliate fees, advertising, subscription, and licensing. And 25% comes from parks and experience. That's the resorts and hotels, the theme parks, and merchandise. That is the revenue of Disney. So let's look at the overview of revenue over the past 3 years. First, what we can see is that the media and entertainment segment remains the main revenue contributor. That's at 50, let's say. Let's go back to 2019, and that was 42.8. We see it rise dramatically in 2020, and then we can see the parks and experience segment was heavily impacted by the pandemic. In 2019, it was 26.8 billion that they brought in revenue. That went down to 17, so nearly half. And they did about 16.5 in 2021, so not even really starting to get a recovery. The end result is total revenue of 69.6, which was up 17% in 2019. It was an amazing year, but then that crashed by 6%. 6 is not actually bad during the pandemic, 2020, and it came from the strength that they had in their media and entertainment business. So Disney's revenue continuously increased, but has not exploded. Here we can see in the past 9 years, the revenue grew at a solid CAGR of 5.3%. 5% revenue growth is pretty good. The company survived the pandemic well, thanks to its new streaming platform, Disney Plus. Revenue from streaming subscriptions partially offset the severe drop from its park and experience segment. But past growth would not be enough to achieve $100 billion in revenue. If we look at this chart and we just extrapolate that 5.3% growth, what we're going to see is that they'd end up with revenue of $79 billion in 2024. And that would not be enough. And I made a mistake on the chart. It says 75 million. It's supposed to say 75 billion. And in the text, I say 79, but I mean 79 billion. So, bad news. If they grow the way they have in the past, they are not going to hit this target. Now, let me take a moment and say hi to Kevin. I see Kevin's there. And I see Dave Buck. Dave, great to see you and great to connect here. It was Great having you as a guest on the show. So this is $21 billion less than the $100 billion mark. So, however, analyst consensus expects much higher growth. So if we looked at the past, which is what we just did, we see it doesn't have the growth. But if we look at the consensus, let's see. Here we can see that analysts expect Disney's revenue to grow at 14.8% CAGR over the next 3 years. Now, analysts are known. In fact, my PhD dissertation was about the optimism of analysts. But boy, that's very optimistic. That means that their cumulative average growth rate is going to increase by 3 times, from 5 to 15%. That's a heroic performance. So this would result in 102 million revenue by 2024. Now, let's just think about it for a moment. Basically, most analysts are just fed information from the company and then they regurgitate that in reports. And I'm sure that's a lot of what's happening here with the analysts regurgitating the goals that the company set. So what needs to happen so that Disney's dream could come true? Well, first, rising costs for affiliate content and advertising should benefit Disney's top revenue contributor. Here you can see the affiliate fees rising slowly, the advertising rising slowly, and TV, theater, and licensing rising a bit more quickly. Now, what you can also see is that the theater one, for instance, is only 20% above what it was in 2019. So the streaming platform, Disney Plus, could be the main growth engine. Within 2 years, Disney Plus contributed $12 billion in revenue, which is around 30% of Netflix revenue. And we can see the red line that you can see here is the revenue from subscriptions for Netflix, which went from 5 billion up to now 30 billion. And we can see Disney went at an even steeper pace in the first years, and it went from almost nothing up to about 12 billion. Now, as comparison, Netflix started streaming services in 2007 and needed 10 years to get to 12 billion in sales. And basically, Disney did it in 2 years. Now, the business model relies on economies of scale. To increase revenues, streaming providers must focus on increasing quantity. And given the intense competition, it's difficult to raise prices. As of 2021, Netflix has over 200 million subscribers compared to Disney's Plus with 118. Now, the chart is interesting here. We previously looked at the subscription revenue, which is the blue line of Disney. And what you can see is that the revenue actually is kind of falling off in 2021. And part of that is that's happening while the subscribers is growing. And what that usually would mean in this case is that the revenue per subscriber is falling. So they're winning this game. They're winning the revenue by cutting the price. Now, let's assume Disney can grow to Netflix level in 3 years. What would it look like? Well, Disney Plus would need to add another 100 million subscribers in 3 years. It's not impossible. If the company could do so, it could generate around $30 billion in annual revenue. So here you're seeing that we're looking at the subscriber base, and then we're looking at the revenue generated off of that. And we can extrapolate that pretty carefully. So here we can look how I incorporate this story into my forecast. Its streaming platform, Disney Plus, is the main driver for growth, reaching 220 million subscribers by 2024. It does not seem unrealistic. I think it could be done. And subscription fees will go up to 30 billion US dollars. And that basically would mean that the total segment of media and entertainment is now having a revenue of 78 billion US dollars. Now, 78 billion isn't 100 billion, but we can look at what's happening in the park and experience segment. Now, before we do that, if you want to learn how to value companies like this, check out my 6-week online valuation masterclass bootcamp. Class starts on May 23rd, and I would love to see you there. You'll learn practical stock valuation skills and apply them to value actual companies. You'll access the tools, tips, and tricks I've used to become a #1 financial analyst. You'll join a group of inspiring, like-minded financial professionals, and you'll get a job through my network of thousands of finance industry leaders. Join by May 2nd for a massive discount, which will get you in at $697. Just scan this QR code or go to valuationmasterclass.com/bootcamp. All right, back to the show. Parks and Experience segment could see a strong rebound. Here we can see the estimated number of annual Disney visitors. Now, you'll notice at the bottom left that I'm using this data from TEA Index, and the company does not disclose the actual number of visitors, so it's an estimate. Now, in total, the company operates 12 amusement parks under the Disneyland brand. That's California, Florida, Tokyo, Hong Kong, Shanghai, and Paris. And in 2021, it reopened up all its locations. Only the Chinese locations face frequent temporary shutdowns. This could delay recovery for the company, but obviously also for China. Now, within 3 years from now, this segment should have recovered fully from the COVID shock. And here you can see that I would forecast to 2024 that segment of Parks and Experience goes back to where it was in 2019. So that's all I'm expecting that's going to happen. And therefore, if we add all that up, what we can see is that the company could reach $100 billion revenue in 2024 with what I would consider to be pretty reasonable assumptions. So the conclusions from this analysis, one thing is we imposed two main assumptions. Number one, full recovery of amusement park, hotels, and merchandise revenue by 2024, meaning it's going to match 2019. And Disney Plus reaches more than 200 million subscribers by 2024, which is roughly equivalent to the current Netflix subscribers. Now, under these assumptions, the US $100 billion mark is possible. So now I ask you, can Walt Disney really hit $100 billion in revenue? And that's my question for you. And hopefully you'll have even a better answer than myself. So that's a little bit of the Valuation Masterclass case study. I welcome questions and challenges. I know that there's many people out there that understand Disney's revenue better than little old me here in beautiful Bangkok, Thailand. So feel free to leave a comment or a link to a place where you've done your writing or you've referred to find that information. Otherwise, I look forward to seeing you in the Valuation Masterclass Bootcamp. Have a great day and a great